You right, guys? Can you guys hear me? Can you hear
Yeah,
me?
yeah, I can hear you.
All right, brilliant, brilliant, brilliant. So, what I want to do is, I just want to say to everyone that can hear me, please mute your mics. Please make sure your mics are muted. Make sure all your mics are muted, and you don't need to turn on your video either. So I'm going to get started now. Welcome to day one of the 2 day webinar. Right, guys, please mute your mics. Please mute your mics. Mute your mics. Mute your mics. Thank you, thank you, thank you, thank you. Right, welcome to the first day of the 2 day webinar with myself, and I'm going to be covering the 3 steps to generating profitable trade ideas. Yeah, I'm going to have a Q&A at the end of the webinar, so any questions you do have, I'm going to you can ask them then. I will do a bit of a learning check as well, so at the end of each slide, because there are a bit of kind of complex fundamentals that I'm trying to simplify, and not everyone's going to follow, probably due to language barriers, etc. So from that perspective, I'm going to try to make sure that everyone is following along, or at least the majority of people are following along after a certain period of time, after you've covered a certain step. And any questions you do have, please type it in the chat box, and I'll try and just recover it just in case, and make sure you're all following. So day one is with me today right now, which we're going to get started in a sec. But day two is going to be with Mark Chapman, and he's going to be covering really the market makers, and really identifying the footprints of the market makers. And it's not anything like what you see on YouTube or TikTok or anything like that. It's the real business model, right? It's not the theoretical side of things. And I do have Mark here with me. Mark, if you want to unmute your mic and give them a little bit about what they'll be getting tomorrow as well.
Hello, guys. How you
Yep,
doing?
can hear
Just
you.
let me know if you guys can hear me. Okay,
Yep.
is that coming through all
Yeah,
right
it's
there?
coming through fine. Yeah, everyone's saying yes.
Super good. 67 people on the call. That's awesome. Welcome everybody. And yeah, as Leon said,
Oh, Mark, you just dropped off. Can you hear me?
there we go. I'm
Yeah,
back.
yeah, there
Am
we
I
go.
back?
Yeah, you're back, yeah.
Hey guys, sorry about that. Yeah, so just to sort of give you a little bit of a brief intro before you guys get going. Tomorrow I'll be holding a class on the footprints of the market whales, and how you can learn to see where they are in the markets, and how you can position yourself to trade alongside them. Today is all about the fundamentals, and Leon's going to go over the 3 steps for generating profitable trade ideas. It's massively helpful, even if you do understand institutional trading strategies, to still have a fundamental bias, to then go onto a chart with an idea of where you want to be trading in terms of directional bias, prior to then deploying those institutional strategies in the market. It makes a great trader a super trader. So I hope you enjoy today's session. Tomorrow's session will be with me, 8 p.m. London, exactly the same time. And we'll be going over essentially how you can see the big money liquidity providers, essentially the market makers. I'm going to be talking about, before being able to see them, you've got to understand how to interpret order flow in the market, actual order flow, not footprint charts or the various types of trading software out there that supposedly shows you order flow on your trading platform. Quite the opposite. This is the purest version of it, how to actually understand the mechanics of price action. And then once you've sort of got the grasp of that, I'm going to be introducing you to the idea that the market is indeed an auction. And from there, we can then learn to understand and see where the big market makers, liquidity providers are positioned in the markets. And I'm going to actually show you their number one footprint. So I'll look forward to seeing you guys tomorrow. Have a great session today. Yeah, I'll see you guys tomorrow. Enjoy tonight.
Yeah, thanks, Mark. Much appreciated. Much appreciated. And yeah, guys. So let's get started because I know many of you, depending on where you are in the world, it's probably late. I had a few people message me saying that it's like 2, 3 in the morning and stuff like that. So I'll try and get this fly through it, but in a sense of like I said, no man left behind, or at least the majority of you anyway can follow along. Right. So. First things first, again, for those of you who have just come in, please ensure that your mics are off, remain off, and that you don't, turn on your video. Yeah, we'll just keep it like that. And yeah, any questions, we'll leave them either to the end or whenever we come to maybe the end of a certain section, and I'll ask if there's anything that you are not understanding, and I'll try and go over it again, right? So hopefully I should cover this within the next hour or so, and then maybe the Q&A might last a little longer. But anyways, let's get into it. So please note as well, it's not necessary to know everything about fundamental analysis. We can literally go down the rabbit hole when it comes to fundamental analysis. There's so many things to learn. And it's not important to know everything about everything, right? What I'm trying to do is I'm going to get you to the place where you literally just focus on what is the most important to make your trading decisions, as well as what really moves the market. Yeah, that is what is the most important thing. Yeah, so we're going to eliminate the noise, ignore the distractions, and really focus on what the central banks, the financial institutions, institutional flow, what they're mainly focused on. Yeah, and what they are focused on overall. Yeah, so let's get into it. Hi everyone. So is this how you trade fundamental analysis? Fundamental analysis is really touted online as going to Forex Factory and looking at news releases and then buying and selling based off of whether it was expected or whether it wasn't expected, right? And so that is not fundamental analysis. That is not how to trade fundamental analysis. I think probably maybe 99% of videos, and by the way, I've been around for a little while. I've probably watched all of the videos. I say all of the videos, but that's a bit of an exaggeration, but I've watched many of the videos that you guys have watched on YouTube back in the day, and I have a little browse on YouTube from every now and then to see if the quality has changed. And to be fair, from when I started trading back in 2012, 2013, nothing's really changed apart from maybe technical strategies, and technical strategies are a dime a dozen, right? But this is not how you trade fundamental analysis. If it was, we'd all be trillionaires, right? Anybody can buy and sell, good news and bad news, but we're all here, right? We all understand that there's obviously more to it than just doing this. No matter what someone on YouTube says, this isn't necessarily fundamental analysis trading. But what is really identifying currency divergences and differentials. It's really important that you understand this concept, yeah? So currencies, as we know, pretty much currency trading 101 is currencies are traded in pairs. But how it's not viewed, or what people may not know or maybe just kind of disregard, is that in fact it is a straight one-on-one fight, yeah? Sorry. It's a straight one-on-one fight. So, it's really about which currency is appreciating or strong versus a currency that is weak or depreciating. Yeah. And what we want to do in currency when we're developing a trade idea is look for divergences or differentials. So divergence really is to, in case your English isn't the greatest, it's really to understand that divergence is where I guess currencies are moving or extending in different directions. Yeah, differentials is just the difference between the two. But what's more important than differentials is the divergence, right? And I'm going to show you pretty much the 3 steps. So when we have a strong divergence, yeah, as far as, a really strong currency or an appreciating currency versus a depreciating currency or a weak currency, that's where you get trending price. Yeah. And when you have a weak divergence, yeah. So, for example, there are two strong currencies versus maybe two weak currencies, or two appreciating currencies versus two depreciating currencies. That's where you generally have, I guess, what Mark would call more of an auction. You might know it as a ranging market, sideways moving market, an accumulation phase, etc. Right? But it's really where you get non-trending price over a certain period. Now, I'm talking about as well applying fundamentals to the medium to long term price action. In the short term, and for a day or for a week, yeah. Fundamentals, and I guess I'll get into this maybe a bit later, but fundamentals can still be applied, but you have to have more of a medium to longer term bias. Medium to long term meaning a month to maybe 3 months, 6 months time horizon, right? Because in the short term, as Mark will go over tomorrow, there's liquidity. The market generally is looking for liquidity, market makers, pricing, fair value auctions, etc. And you'll find that out, tomorrow. But from a macro perspective, a macroeconomic perspective, this is what we're looking towards, the big trends, yeah. And so step one is really is really identifying interest rate divergence. Yeah. If you want a shortcut as to understand which currency you should be buying against which currency you should be selling as far as divergences, it's looking at interest rate divergence. Yeah. You must look at interest rate divergences. And all roads lead to interest rates. Yeah. Meaning, what that means is that you've got, many different macroeconomic data points. For example, you've got retail sales, you've got home buying, you've got. Hello, guys. Please, can you mute your mics? If you don't mute your mic and you keep, repeat offending, I'm going to kick you from the from the call. So please just ensure that your mic is muted. Please, Justice, Kofi. Ensure that your mic is muted. If you don't mute your mic and you keep disrupting, I'm going to kick you. Right, so all roads lead to interest rates. So there are many different data points that we look at, for example, on Forex Factory, but all roads lead to what the central bank is going to do with interest rates. Yeah, and central banks manage and influence currency valuation. Right, meaning they either want to appreciate or depreciate the currency, or keep the valuation as it is by either increasing, decreasing, or holding interest rates. Yeah, so all roads lead to what the central bank is going to do. Whether you're looking at, like I said, retail sales, whether you're looking at manufacturing, whether you're looking at producer prices index, whether you're looking at employment, unemployment, all roads lead to. All those roads lead to what the central bank is going to do. So if you wanted the shortest way to understand which way you should be buying or selling, is look at what the central bank is doing with, or central banks are doing with their interest rates. And it really, in case you don't know, an increase in interest rates is currency appreciation, and a decrease in interest rates is tends to lead to currency depreciation. Yeah, not saying that price is going to go up every single day, every single week, every single month, for example. Right, it's a bit more complex than that, but the general path of least resistance will be currency appreciation. If they hike rates and if they cut rates, then you should see currency depreciation. Yeah, now interest rates, just in case you don't know, think about it like this: is obviously interest rates is the return that you get for depositing your money in a bank. Yeah. So an increase in rates is basically the yield that you're going to receive for depositing, money into your bank account. So think about it like this, where you have two banks on a high street. Yeah. And one is offering 5% interest rate. So, you're looking to, put your savings somewhere. One is offering 5%, one is offering 1%. Everyone's going to go to where they're going to get the most yield, right? The most return on their money. So the demand for the higher rate, yeah, in simple terms, will cause demand, which demand will cause currency appreciation. And it's the same thing in currency land. When you're looking at it from an international investor perspective, investors generally will put their money into certain currencies or into all currencies, right? And so if you have a central bank, right, or a currency that is, giving you, maybe 4% to hold that currency versus another currency that is, offering you maybe 0%, yeah, the money is going to flow into the one that is the higher interest rate, yeah. So again, the shortcut is really to listen or to read central bank statements and news articles to determine what central banks are likely to do with interest rates. Yeah, whether they're likely to hike, hold, or cut. So raise interest rates, cut interest rates, or cut interest rates. Right. So that's the shortcut of it all. Yeah, but you might be thinking, well, what determines the central bank's decision to hike, hold, or cut rates? How do we get ahead of the central banks? How do we know when they are going to do it or when they're likely to do it? So step 2, yeah, is understanding the business cycle, gross domestic product business cycle. So divergences and differentials, yeah, is really important to understand it. So gross domestic product is the value of an economy's goods and services, yeah, and the GDP and I guess the business cycle can be described as having phases. So we have the boom, contraction, recession, bust, slump, recovery, expansion, and then back to boom again. And it literally goes round and round and round in circles. So boom, contraction, recession, bust, slump, recovery, expansion, boom, contraction, and that is really the cycle, yeah? And it's important to understand that in the recovery or expansion or boom phase of the business cycle, yeah, business and currency demand increases. So look at it like this. If you're, again, an international investor, yeah, and you want to invest in certain economies, and you've got certain businesses that you want to set up, for example, and you're thinking, well, should I go to Europe or should I go to the UK? Yeah. Now, the UK have got, we're in maybe the expansion or the boom phase, right? There's lots of demand, there's growth there, businesses are growing, etc., etc. My people are spending money, people are borrowing, lending, etc., right? The economy is doing really, really good. Versus setting up, for example, in Europe, where they're maybe heading into a recession, right? Where they're heading into a recession, where people are not spending money, businesses are going bust, and there's not too much going on, right? We all know what recessions and bust slump, feels like, right? We went through it just with, COVID in 2020, right? So where are you likely to place your money? And I guess it's a rhetorical question, but it's going to be, everyone's going to flood into the economy where you've got growth, yeah? And that creates not only business demand, but it creates currency demand, because in order to do business in that currency, yeah, you're going to have to buy it, right? You're going to have to buy that currency. So from that perspective, you can see the divergences. So what you ultimately, and the differentials, I guess. So ultimately what you want to try to do, the first step you want to do is understanding where a country potentially is, in its business cycle. Is it growing? Is it in the recovery, expansion, boom phase of the business cycle? Or is it heading into a recession, bust, slump cycle of the business cycle? And you can find that out literally just by reading, the news, looking at the data, right? So GDP, business cycle, divergences. Yeah. So remember this: central banks typically increase interest rates during the recovery, expansion, and the boom phases of the economic cycle. Yeah. And central banks will typically decrease interest rates during contraction, recession, bust, slump phases of the economic cycle. So when we're talking about, again, divergences or differentials, yeah, once we know where an economy is, yeah, then we kind of have a clue as to what the central bank is typically going to do, whether they're going to hold or hike, yeah, when the economy is doing really good, or in that recovery expansion phase, and they're likely to potentially cut rates during, economic downturns, contractions, bust or slump phases, right? So many of you obviously, would have obviously been paying attention to COVID, right? But how many of you, were paying attention to what the central bank was doing, during that time in 2020 in March, and what central banks did with interest rates? Yeah, the central banks all around the world started to cut interest rates. Yeah. So just as a rule of thumb, yeah, meaning that just what typically happens, we know if the central bank or the economy is heading into a recession, yeah, potentially they generally want to cut rates, and if an economy is expanding or in the recovery or the boom phase, then central banks will typically increase interest rates. So you can look for, again, the divergence, right? So GDP, business cycle divergence differentials. That is what we need to do in a really kind of simplified form. Yeah. Is everyone following along? Yeah. If the majority of you are following along, then I will continue on. If there's maybe one or two that are not, unfortunately, I'm going to have to just continue. Everyone's following along. You can type yes, Y in the chat box. All clear, brilliant, all good, all good. Frobby, excellent. Welcome, Frobby. Thomas, excellent. All right, brilliant. So, divergences and differentials. That is, and it's not me saying this, by the way. It's not my theory. This is, economic theory. This is the rules to the fundamental game. Yeah. So, here's an example, right, of GDP business cycle and I guess divergence and differentials. And what we're looking at is the euro dollar, right, the most traded forex pair. Now, we'll look at what happened, I guess, from last year, right, from 2021 over the whole year. Now, from January 2021 to really this year, we had some negative growth, right, in Europe. And, we did get a little bit of growth, but then we kind of came back to 0.3%. Yeah. So you can see we had some negative growth. 2 quarters of negative growth is deemed as a recession, right? So Europe were in a recession. Yeah. Technically, and then came out of it, but then had some pretty much, limited growth, very weak growth, economic growth, right? When you compare that to the dollar, the US dollar, you saw the US dollar around January, February, March, April, and all these quarters, right? We had growth, 4.5%, 6.3%, 6.7%, 2.3, 6.9 was the most recent reading, right? Percentage. So you can see, yeah, the difference between the two, yeah? So obviously the one you should have been looking to buy, yeah, is the dollar, and you're looking to sell the euro. Yeah, that is the difference. That there's differentials and divergences, and sometimes you might not necessarily get a divergence where they're moving in different directions. But if you can see the differentials, that is also what will help you to make, or one of the steps to make you understand what the central bank is likely to do with interest rates, because that is what is most important. What is the central bank likely to do with the valuation of the currency? Are they looking to hike rates, which means appreciating the currency, or are they looking to cut rates, which is going to be to depreciate and devalue the currency? Yeah. So this is one of the steps. Now, the second step, and step number 3, I guess, is inflation. And this is where a lot of traders tend to have maybe a bit of trouble understanding the impact of inflation on what the central bank is going to do, and how it factors in. Right, so let me just I know Richard and Patricia is new. You're right, to the new attendees who have just joined. Just a quick housekeeping. Just make sure that your mics are off and that your videos are off as well. And yeah, I'm going to have a Q&A pretty much at the end of the webinar. And welcome, by the way. So the inflation divergence differentials, right? So inflation is the currency's purchasing power, yeah? And actually rising inflation, yeah, equals currency depreciation and devaluation, yeah? Now, many people think that inflation means an increase in value. No, in fact, it's the absolute opposite. Yeah, and I think that they've deliberately labelled, and I say they, but the the smart money, I guess, have deliberately labelled and mislabeled the what inflation really is, in a sense that, to confuse the general public. Just my conspiracy theory, but inflation is actually a devaluation of the currency. So can you guys see my pen tool? I'm just writing something. Can you see that? Can you see that, guys? Can you just type a yes? Yep. Brilliant. Excellent. Right. So inflation. Right. So inflation, INF, right, in fact means devaluation. Devalue. Yeah. Or depreciation. Stroke depreciation. Sorry for my writing. I'm on a trackpad at the moment, right? So that's what inflation means. It's the higher the higher that inflation goes, right? From from 0 to 1. Oh, that's supposed to be a a 0, but let's say 0%. Yeah, these are all percentages. 1%, 2%, 3% is the more devalued your currency is. So your purchasing power is decreasing in value. Yeah. And so falling inflation means that the currency is actually appreciating. Yeah. So if the currency is going from, for example, 4 to 3 to 2 to 1, in fact, it's actually appreciating. Yeah. It's getting more expensive. So there's some inverses here. Yeah. So yeah, I know, Lawrence, don't worry, I've got it, thanks. Yeah, so just understand that inflation means devaluation, depreciation. Yeah, so rising inflation means your currency is getting more and more devalued. Yeah, now falling inflation, yeah, means that your currency is appreciating. Yeah, so your currency is getting more expensive. And what can happen, yeah, is where you have deflation, right? So you've got deflation, DF, right? And that actually is appreciation, APPRECIATIO. I hope my writing is okay. Hope you guys can read it. Appreciation, right? So it's getting more expensive, right? So with that being said, yeah, rising inflation, devalue. Deflation is actually appreciation. So inflation, yeah, is influenced by who started their video, by the way. Please turn your video off. Turn your video off. Turn your video off. Can the person who has started their video please turn it off? If I find out who it is, you're gonna get kicked if you don't turn it off. Right. Sorry guys, 1 second. Done. Right. Right. So, with that being said, just disturbing the flow of the webinar. Right. So, where was I? Inflation is influenced by other countries, right? So, central banks try to control inflation, yeah, via interest rates. Yeah, and inflation is influenced. So rising and falling is inflation is really influenced by other countries' currency valuations, right? So, for example, their GDP and their interest rate policy, as well as supply and demand, QE, commodity scarcity, supply chain, and wage growth, etc. So, think about it like this: if inflation is going higher, if inflation is going higher, yeah, what does the central bank have to do to interest rates? So if that's inflation and this is interest rates, yeah, and remember, a hike in interest rates does what? It appreciates the currency. Yeah, so appreciate, I can't be asked to write it all out. Yeah, but if this is, for example, 0, that's 1, that's 2, that's 3, yeah, and that's 4. Yeah, if inflation is going higher, meaning it's being devalued, to counter that devaluation, yep, as Asabi has said in the private, and as well as Artraf, yeah, exactly. They have to look to do what? They have to hike rates, exactly. Yeah. So the higher inflation goes or devalues, they have to then start to appreciate the currency by hiking interest rates from 1 to 2 to 3 to 4. Yeah. That's what they have to do. That's what they have to do. So the more inflation goes higher, is the more you have to hike rates. Yeah. That is how they counter inflation. That is exactly how they counter inflation. And it's the same thing when you have deflation, so appreciation. Yeah, they have to actually end up cutting rates to devalue the currency. Everyone following? Everyone following so far? Yep. Brilliant. Everyone following? Brilliant. Fantastic. So that's what you need to understand when it comes to, because at the moment we're in an environment where we're suffering with high inflation, right? I think what was it? The last reading was 7.5% in the US, something like that. It's crazy. So as you guys know, what is the Federal Reserve looking to do with with interest rates? Everyone knows this, right? They're looking to hike interest rates. It's no mystery. The higher inflation goes, it forces, or it's one of the factors that forces the central bank to have to appreciate the currency. Because at the moment, the US, if you're living in the US, your currency is being devalued, at the moment by 7.5%. Yeah. So these again this is the rules to the game, guys. This is not, some, Leon making it up or whatever it is. This is what the banks look at. They look at GDP and they look at inflation, right? So here, in fact, let me give you a bit of a question, yeah, because many people do get this wrong in their understanding. So a chocolate bar or whatever, yeah, but a chocolate bar cost £1 last year. The chocolate bar in 2022 has gone up by 10 pence, so it now costs £1 10 pence. Has the value of the currency appreciated in value, increased in value, or has it depreciated? Has it devalued? Q says devalued. N says decreased, depreciated, devalued, decreased, devalued. Excellent. Anybody think the currency has actually appreciated in value? Everyone says pretty much devalued. Brilliant, guys. Brilliant. Excellent. So you're not understanding this. Excellent. Welcome, Ken. So yeah, brilliant. And the reason why is because it takes more of that currency, yeah, to buy a chocolate bar. Yeah. If it only cost you £1, but now it costs you £1 10, it's taking more of those pounds to buy the same chocolate bar. So in fact, your currency is being devalued. That's exactly it. Yeah. And you can get into things like, hyperinflation. Yeah. Lax says, only understanding because you're explaining it so well. Did not before. Oh, brilliant, Lax. Thank you. Thank you very much. Yeah. Brilliant. Excellent. So this is what inflation is. Yeah. This is what inflation means. Devalue, depreciation. Yeah. And on the other end, just to go over it quickly, if this is interest rate hikes, yeah, these are hikes because you're increasing, you're going from 1 to 2, 2 to 3, 3 to 4. On this end, you've got negative interest rates, which we've just pretty much come out of, right? In certain countries still have it. So -1, -2, -3, for example. Yeah. And what that is, yeah, and deflation would be, for example, -1, -2, -3. Yeah. And remember, deflation is currency appreciation. So as the currency gets more expensive and appreciates, remember, cuts, if this is an appreciation, cuts mean devalue or a depreciation, right? Right, so depreciation. So if inflation is appreciating, the central bank then has to go into negative interest rates if they don't have any more interest rates to cut, because they might go from 2 to 1, from 1 to 0. Yeah. But if inflation inflation goes to deflation, for example, yeah, it keeps appreciating, then what happens is the same thing. They're going to have to keep cutting in order to try to bring the deflation back to, and really the central bank's target, right, inflation rate every year is actually 2%. Yeah. So when inflation is at 2%, central banks will hold rates generally. Yeah, they are mandated. Yeah, and I'll get into that in the next slide. 2% inflation is what central banks are mandated to try to get inflation to. Why? They see that as as acceptable. It's almost like the Goldilocks economy, where in our current form and what we have, they think that 2% is really not too hot, not too cold, right? When it comes to currency appreciation and depreciation. But just understand that they are mandated generally to 2%. Some central banks are around maybe 2.5%. I've seen even 3%. But the ones that are generally in the currencies that we trade, maybe the G10, including the New Zealand dollar, it's usually around about 2% to maybe 2.5% is what their mandate is. Yeah. That's what it is. So whenever you have an appreciating currency and deflation, generally central banks will cut rates. Yeah. And when you have inflation that is going higher, meaning devalue, central banks will try to appreciate. So they're always trying to counter. Yeah, they're always trying to counter the devaluation of their currency or the appreciation of their currency. Can it be 2% in different inside? Yeah, it can be. It can be. Not every country, because China is a whole different story, right? The People's Bank of China, they pretty much set their rates, right? I don't think they have they don't have a free floating currency, but that's getting into something else. As long as you guys understand this, yeah. As long as you guys understand this, this is what is going to generate you trade ideas forever, right? Forever and a day. As long as we have currency, as long as we have central banks, as long as we have the current system, this is how it is done. This is how it is done. And I've got some of the guys in the room from my private Discord group, and they will tell you, if you ever speak to them, I've been doing this a long time, and it's pretty much that's what we do week in, week out, month in, month out, year in, year out. Yeah, generate these ideas. Right. So as long as you have growing inflation, growing inflation, but you also have GDP growing at the same time. Yeah, you got to have both. If GDP is growing, inflation is above that 2% target, yeah, then central banks will typically hike rates. That's exactly what they're going to typically do. And once you understand that, you can get ahead of the central banks and start to position yourselves to either go long or short, because you're going to find one current central bank that is looking to potentially hike rates and another one that is going to either looking to cut rates or just keep rates as they are. Yeah. So there are a few divergences that we can look towards. Yeah. So you want to buy the currency that is hiking rates versus one that is holding rates, and preferably one that is cutting rates, because there's a gap there. There's a differential there between a hike and a hold, and an even bigger gap between a hike and a cut. Yeah, and that's when you see, hiking, holding, cutting. Yeah, when you can see central banks that are really diverging in their monetary policy. Yeah, that's where you get those trending markets, either to the downside or to the upside. Yeah, depending on which is the base or the quote currency. So again, we're going to do a bit of a learning check for everyone. One sec, I'll clear all the drawings. You're right, Dan, just mute your mic or I'll mute it for you. Thanks, Dan. Welcome, by the way. So again, the rules to the game. Here are the rules to the game. The central bank has an inflation target of 2%, right? So they're mandated. Yeah, they're mandated. That's the line in the sand. This is the target, I guess. Yeah, so 2% target. By the way, if you don't believe me on any of this, you can always Google it, right? Google is your friend. Right, so that's the target, 2%. Now, if inflation is above the 2% target, yeah, and trending away from their 2% target, you will have, a rate rise, a rate hike. Yeah. And if you have inflation that is above the 2% target but trending towards their target, they generally will hold rates. Central banks, yeah, they don't like to really mess with interest rates. They don't like it because it can have, and hiking, hold, and cutting rates can have positive effects on the economy, but it can also have negative effects if they get it wrong, if they hike too much or if they cut too much. Yeah, because of borrowing and lending, spending, etc. Yeah, so I give an example. Imagine if interest rates, were like at 10% right now. How would that affect your business? How would that affect, borrowing and lending? If, in interest rates were at 10-15% right now. It'd kill you, right? You know what I mean? It'd be too much, right? Exactly. It's bad. That's exactly it, Q. Bad for GDP, right? So it's not that they don't want to, they don't like to hike or cut. In fact, they would prefer to hold. Yeah, they would prefer to hold, and they really kind of hike or cut rates, when they are really kind of forced to. Yeah, they're really forced to. So just as a rule of thumb, central banks would try to hold rates for as long as they can. Yeah, until they're really kind of forced to. Again, look at what's happening with the US and the Federal Reserve, right? Pretty much they keep increasing their projected hikes, for the US dollar. Before it was like, I remember when it was, they were going to maybe do it 3 times, then it's turned to 4 times, then it's turned to 5 times, and now it's turned to, well, instead of hiking 25 basis points or 0.25%, now they got to hike 0.5%. You know what I mean? Because they're constantly increasing it, because inflation, and we'll see it in a minute, is constantly kept rising. Yeah. Asabi says, highly on the third bullet point, please can you read and explain it? Yeah, I'm going to get to that in a sec. So if inflation, is above the 2% target and trending towards the 2% target, they're not going to want to cut rates, are they? They're just going to leave inflation to do what it does because it's coming back to their 2% target. Yeah. Does that make sense, Asabi? I think that's the third point. Or is 1, 2, 3? Or are we talking about if inflation is below the 2% target? Right, okay, brilliant. So now, if inflation is below the 2% target, so inflation is somewhere around here, like, 1%, yeah, and trending away from their 2% target, yeah. Remember, inflation going lower, yeah, from 1 to 0 to -1% to -2% means that the currency is actually appreciating, right? Right. So this is appreciate, and this is depreciate or devalue. Yeah. That's how to look at it. Above that line, devalue. Well, actually, that even 2% is really being devalued, but it's acceptable devalue. But anything below 2%, they look at it as appreciate. The currency is appreciating, getting more expensive. So if the currency is already, inflation is already below the 2% and trending away, it's appreciating, and they're not reaching their 2% target, which means that they have to cut rates, and cutting rates means they have to devalue the currency. Yeah, they have to counter the appreciation by devaluing the currency to bring it back to the 2% target. Yeah. But if inflation is below the 2% target, but automatically trending towards that without actually having to do anything, then they will hold rates. There's no need for them to hike rates when prices are below it, right? And they don't want to cut rates because inflation is already trending towards it. And like I said before, central banks don't want to, tinker with interest rates, with their own interest rates, because it can hurt the economy. So they'd rather let it naturally get to where they want it to get to. Yeah. So these are the rules to the game. And if you understand this is evergreen. Yeah. Forget looking at Forex Factory and trying to trade, any kind of retail sales or anything like that. All roads lead to this. Retail sales, employment, unemployment, it all leads back to GDP and inflation, and therefore interest rates. Yeah. Is everybody following? Everyone follow that, yeah? Thato says, Leon, can inflation of a country, you just went off, country be affected by the global economy? Yes, it can. It can. For example, you've got supply chain problems, right? You've got scarcity. And the like, you've got commodity prices that do affect inflation. Yeah, but it's not right now. I'm trying to keep things as simple as possible. Yeah, we're trying to keep things as simple as possible. But the answer is yes. Yeah, inflation of a country can be affected by the global economy, depending on where they're located and who their trade partners are. Yeah, I just give a quick example of that. For example, Australia, right? So China are the world's economic engine, right? If China, the saying is if China sneezes, then the whole world catches a cold. If China go into a recession, it will generally affect the globe because of globalization, right? So the countries that are going to be really affected by that, by China's slowdown, yeah, is going to be Australia and New Zealand. Typically Australia, because they, that's their biggest trade partner, right? Iron ore, that's exactly it. Artraf, right? Iron ore, copper, for example, gold, etc. So basically, China will be buying less of those commodities, yeah, because they're going into a recession, right? They can't afford to. The infrastructure projects have come to a halt. They're not spending as much, yeah. So if Australia then are selling less to China, then that's going to affect not only their GDP, but it can affect inflation, because commodity prices are included, I guess, with inflation readings. Yeah, so it can affect it either directly or indirectly, also depending on where you are in the world. Yeah. So yep, that is that. So let's move on, and I'm glad everybody is following. Brilliant, excellent, excellent, excellent. Right, so here we go. Here we are with inflation divergence, I guess, differentials, right? And again, euro dollar. Yeah. So let's go into the euro dollar. So you can see, hopefully you guys can see the. 1 second. Let me just change the color of this pen tool to. I'll do it red. Excellent. Right. So this was last year, right? So for the whole of 2021, beginning of 2022. Yeah. Now, remember I said that the mandate for the central bank is 2%. 2%, 2%. Yeah. When prices are above 2%, yeah, and trending away from that, then it's one of the things that can force a central bank to want to hike rates. Of course, we must remember GDP. GDP must support a rate hike. So you have to have GDP growing at the same time. Yeah. So in the US, around April, you had inflation at 4.2%. Crazy, pretty much double their mandate, right? Whereas in April, yeah, of 2021, sorry, I said 2022, didn't I? Yeah, so April of 2021, yeah, is 4.2% in the US. Europe was 1.6 in April. So again, what do you think? Who was under more pressure to hike rates? Which country was under pressure? Here we go. You're a clever lot. Yep, you're getting it. Yep, exactly. The US, right? The US were more under pressure in order to hike rates than Europe. Europe were pretty much looking to hold rates. So understanding that, yeah, the path of least resistance, if you actually look, and the same thing, continued on, right? So the same thing continued on for generally, July, August, and even though price inflation did go higher in Europe, and it's going higher pretty much everywhere in the world. Look at the numbers, right? Look at the numbers. You've got 4.95, 5.1, whereas you've got 7%. So which currency is being devalued more? Is it Europe or is it the US? Who's suffering with the most devaluation of their currency? That's exactly it. So which central bank is likely, as we know, the central bank that is likely to act first when it comes to hiking rates? Exactly, the Fed are more aggressive. Simple. Yeah, the Fed are more aggressive. Yeah, that is it. So with that being said, over the year, right, we can look back over the year and we can see where the path of least resistance was. So again, just quickly, do you think, if we're looking at the year, right, we're looking at the whole year, right, of the euro dollar without looking at the chart, no cheating, yeah, right? Do you think the euro dollar went up or do you think the euro dollar went down over the year? Leah says down. Oh, Q says up. Euro dollar, right? So euro dollar pair, yeah, euro dollar, just make sure, yeah. If we're looking at the euro dollar over 1 year, because we can see 1 year's worth of data here and here, where do you think the euro dollar went? The euro dollar, by the way, I'm seeing up, I'm seeing down. Well, why would you buy the euro over the dollar if we just established that the Fed are more aggressive in hiking rates? What is hiking rates? Hiking rates is appreciating, right? Appreciating the currency. Right. There we are. For those of you who were saying up, I don't think you've understood. You've understood, man. Exactly. Down, Q. That's exactly it. You're buying the dollar, right? You're buying the quote currency, meaning that if you want to buy the quote currency, yeah, then you really, on your broker, you're pressing short, right? If you're buying the base currency, it means that you're buying, you're thinking that prices are going to go higher, right? So in order for you to buy the US dollar, meaning that you think the dollar is going to appreciate, right? The euro dollar went down over the year, yeah? And this is provable by, The next slide. This is what happened over the year. Yeah. Combining inflation and GDP cycle divergence differentials. Yeah. This is what happened over the year. Prices fell from probably around 1,000 pips over the course of over 1,000 pips over the course of the year. Yep, the path of least resistance was to the downside. Yep, we had a moment where prices went up, but overall, the trend was to the downside. Yep. Predictable. And many of the guys, in the group will attest to this. We were going short on the euro dollar last year. No longs. I didn't take one long euro dollar trade. Mercedes, welcome, but keep your mic muted, please. So that is pretty much what happened. Yeah, light bulb moment. How many of you are getting that light bulb moment? Yeah, we'll do it again, right? We'll do it again. We'll do it on another pair. Yeah, again, last year. So combining inflation and GDP cycle divergence differentials, and we do it on the dollar yen. The sun is in your eyes. It's still a bit confusing. What? I can't really ask. Unfortunately, is it Mr. Sean? Why is it confusing? What is it? Because I did ask if everyone was following along, and everyone was saying yep, and then all of a sudden now there's a bit of confusion. What is it that's confusing? That's confusing you. If it's easy for you to speak, then turn your mic on. The PM, Mr. Sean. I can't pronounce your first name. I don't want to butcher your name. Is it Amo Gelang, Sean? All right, let me go back. Just for anyone who's confused. Yeah? Just for anyone who's confused. So, inflation, remember, is devaluation. Right? So inflation is devaluation. Yep, devaluation. Interest rates combat devaluation, or try to combat devaluation, yeah? Because by hiking rates, you are appreciating and you're creating demand for the currency. Yeah, so ION. Right, so a hike in rates or a rise in rates. So if something is becoming more devalued, the only way to get it back to the 2% target is to try to appreciate it. That's it. So the central bank is likely to hike rates. And if they're hiking rates causing an appreciation, then you should be buying the dollar, because the euro are not looking to hike rates anytime soon, because they were lagging behind. Yep, it's clear. The rising inflation in the US meant devalued currency. That's why it was confusing. The rising inflation in the US meant a devalued currency. Yes, and that's exactly why Asabi. I truly believe that they deliberately called inflation. Inflation should actually be called deflation, and deflation should be called inflation, because inflation you think is an increase in value, and deflation would be a decrease in value, right? But they did it the opposite way around, and I do honestly think to confuse people. If inflation for the US is still going, one second. So Mr. Sean said, if inflation for the US is still going down, wouldn't it mean that the US is weak? Okay, so you're just let's focus on what I'm saying right now, because nobody's talking about inflation going down, right? I'm giving you an example of inflation rising. Yeah, so understand what I'm saying right now. Don't let your mind wander anywhere else. You need to focus on what's going on right now, right in front of you. Yeah. So if you don't understand this, then how can you ask a totally opposite question? You have to just focus on what's going on now. You understand inflation is devaluation. And in order to combat devaluation, to stop the devaluation of your currency, you need to try to appreciate it. And the only way the central banks can try to appreciate it, to combat the devaluation, to counter that, is to hike. So the more devalued it gets, is the more they're going to hike. Yeah.
I have a quick question.
Right. Right. Okay. All right. I'll allow you to speak, and then I'm going to move on. Yeah. All right. Let's go.
All right. So, did the Fed increase the rate? Like, did they hike, or just because of the probability that they're going to hike, make people trade against euro?
They don't know. They don't care about that. They care about their economy and they care about inflation. Yeah, it's not about whether it's against the euro and it's against it. Nah, like they got issues. They couldn't care less. They're trying to manage their economy. Do you know what I mean? So just literally don't bring in anything else. I'm just giving you the keys. I'm giving you the rules to the game. Just look at the data. That's it. Yeah. They got inflation problems. They're mandated to bring inflation to 2%. They're mandated. Mandate means that they have to do it. They have to do it somehow. Yeah? Central banks are mandated to do it. So, if they're mandated, mean it's a must, then they're not concerned about what's going on in Europe. They just want to get to that target. Yeah? So they have to appreciate it. But anyways, we spent a while on this. I want to get to the US dollar. I'm hoping that everybody is clear on that. If not, unfortunately, I don't know. I don't know what else to say. I don't know what else to say. Okay, brilliant. You guys are getting it right. By the way, guys, I know you guys are commenting in here, but I can't. Just to get through this, to get through the presentation, I kind of have to maybe focus more on the presentation, and then we're nearly there. By the way, a few more slides, and then we can ask all the questions you want. So another maybe 10-15 minutes, right? So let's look at another example of what happened last year. So you've got US inflation, yeah, as we know, is at around 7%, right? Or it was rising, yeah. So it went from 1.4 to 1.7 to 2.6 to 4.2, and it was really, going higher, right? Above their 2% target. Now let's look at the yen, yeah. The yen had negative inflation, right? Minus inflation for pretty much January 2021. And they've just now kind of come positive, and that positive is basically 0.8%. Yeah. So then you've got what? A check in the check column. Which one do you want to probably look to buy? You want to look to buy the US dollar, right? You're definitely looking to buy, because the central bank, the Bank of Japan, yeah, is not going to do anything with interest rates. They're doing absolutely nothing with interest rates because they don't have to. Yeah, they shouldn't. As we said, if this is their 2% target, yeah, and inflation is below their 2% target, which it was like in the negative. This is like negative whatever it is. Yeah, and prices are trending towards their 2% target, they hold. And that's basically what they were doing. They just literally held rates. Whereas the Federal Reserve are looking to hike rates. Look at the economy. And then let me zoom in, I guess, a bit, because I know it's a bit small. Yeah, so let's look at, so we're looking at US GDP. Again, we know that for sure, 4.5, 6.3, 6.7, 2.3. So we had, nice, healthy economy. Let's compare that to, Japan, negative, tepid growth, negative, right? With the last, couple of readings. So they weren't doing too great. So again, when we understand the divergences and the differentials between the two economies, yeah, what is the central bank likely to do with interest rates for the US? It's likely to, obviously we know that for a fact, is hike rates. Japan, hold rates, right? Hike rates, hold rates. So we're just gathering evidence, yeah? So there's a differential, there's a divergence there, right? Remember I was saying about divergence is you've got divergence at hike, hold, or cut. The best trade is basically, hikes versus cuts, but there's still a divergence between hikes and holds, yeah? So understanding this, yeah, what do you think, in what direction do you think the dollar yen went last year? Higher or lower on a price chart? Up, higher, long. Everybody getting it right. That's exactly it. Brilliant. Higher. Yep. Brilliant, guys. Excellent. And if you look at this, remember this is a year's data. This is all a year's data. Yeah. Fundamentally, this is what happened. Yeah, over the year. It went from pretty much 102.50 all the way up to 115s. So that's literally around about, maybe 1,300 pips. Yeah. So that is it. Yeah. So combining those cycles, right, and the differentials and the divergences. Yeah. So just to round off now, because I've been doing this for an hour and I wanted to keep this, around about an hour and a half or so, hour 45. So combine inflation and GDP cycle divergences and differentials with leading and lagging monetary policies. A leading and lagging monetary policy. Yeah. Now, one of the things you must look towards divergences as well as leading and lagging policy. I don't know why I can't say lagging properly. Anyways, so with leading and lagging, monetary policy, let me just explain this. So this is from ING Bank. ING Bank do central bank. They're forecasting what the central bank possibly may do. Yeah, by looking at GDP and inflation, as well as some other things as well. But generally, all roads lead back to these two. Yeah. Now, one of the things you want to do is you want to look to see who is looking to hike first. Yeah. So who is hiking first? Right. So who's first to hike? Who's second to hike? Who's first? Who's third, last? And compared to who's last to hike. So who's hiking first compared to who's last? Oh, that's right. That was meant to be a T. Sorry about that. Yeah. And you want to buy the currency, or I generally buy the currency who is hiking first, because what is hiking? Hiking is appreciating versus the currency that is not looking to hike at all. So, and secondly as well, right? Secondly, who is hiking more? Yeah, and who is hiking less? Because the more hikes means that they're looking to appreciate their currency more. The less hikes that they're projected to do in the year means that they're not looking to hike as much. They're not looking to appreciate their currency as much. Yeah. So you want to you want to take into account who's first, who's second, who's third, compared to who's last. There's a divergence, and then who's hiking more compared to who is hiking less. And this situation and this, I guess, this graph is basically just showing you, for example, for 2022, right? 2022, the quarters right here, what they expect the central banks to do. So again, Federal Reserve looking to hike once, twice, 3 times, 4 times, 5 times this year, compared to what Europe, who generally, I think now this has kind of changed. I think the expectation with Christine Lagarde when she came out, was it last week or the week before, pretty much indicating that they may want to hike rates in the fourth quarter, right? So that actually should have a bit of an arrow there potentially. Whether they will, whether they won't, who knows? But, pretty much the Federal Reserve should be hiking more than the European Central Bank. The Bank of England, as we know, have been hiking rates, but less so than the Federal Reserve. Bank of Japan, not looking to do anything. Bank of Canada are looking to hike quite a lot. Yeah. Reserve Bank of Australia is starting their first hikes, I guess, in the second quarter, of this year. again, Swiss National Bank, probably fourth quarter of 2023. So again, you can pretty much see who is hiking and how much they're hiking. And you generally, over the medium to long term, want to look towards buying the currencies that are looking to appreciate their currencies than the ones that aren't. Yeah. So leading and lagging is really important. 1 second. So, and again, we can just look at various. This is just basically a map from Bloomberg, right, showing you central banks take hawkish stance, and more than a dozen have already hiked rates in 2022, with more to come. And it just shows you, from I guess a global perspective, who is hiking, who has held rates, and who is cutting, right? So you can start to look and see which countries you should be buying, and which countries you should be selling. Of course, I'm not looking to buy anything that's not, one of the major or exotic pairs. And exotic, I mean, pairs like, for example, Euro, New Zealand. I'm still only looking to trade, the Swiss franc, Japanese yen, Canadian dollar, Australian dollar, New Zealand dollar, pound, yen, and euro, right? And the dollar. Those are really the currencies that I'm looking to trade, right? And I'm looking at differentials and divergences between those, right? So ultimately, we need to think like the central bank. Yeah. What are they likely to do with interest rates? Right? Appreciate or depreciate the currency when looking at GDP and inflation data. What are they likely to do? Yeah. And with fundamental analysis, what we're doing as fundamental analysis protagonists, we're looking to buy the rumor and sell the fact. So again, we think like investment banks and funds, because the investment banks and funds take their cues from what the central bank is going to do. And they're what is called the market. Whenever people refer to, what the market thinks, it's the investment banks, the hedge funds, the sovereign wealth funds, the family offices, etc. Right? Those are the buyers and sellers of the currency, and those create the demand or the supply, etc. Right? But they're taking their cues from what central banks do. Yeah. So, in order for you to, again, want to buy or sell the currency, yeah, and buy the rumor, I guess, is what I meant to say, right? The data must support the rumor or the narrative. It's really important that you understand this, because yes, we can understand that, let's say for example GDP, yeah, is on the rise. Oh, brilliant. Leon said GDP is on the rise. Excellent. I want to be buying. First of all, you really want GDP and inflation, yeah, to be on the rise. But let's say, for example, we have inflation. And let's say, for example, inflation is at, 2%. Yeah. GDP is on the rise. Now, if inflation, yeah, it doesn't mean that they're going to hike rates. But let's say, for example, the inflation starts to look like it's going higher, yeah, maybe 2.1%. And there's rumors that they may want to hike rates, yeah, because maybe inflation is going maybe slightly beyond their 2% target. And I wouldn't even say 2.1. I would probably say maybe something like maybe 3%. Yeah, 3%. Central banks start to maybe wanting to try to talk it down or whatever it is. Yeah, let's say for example it's a 3%. Now, if the next reading, let's say for example, is maybe 2.8%, yeah, it doesn't support the narrative that they're going to hike rates, because they think, that obviously there's a 2% target that they're mandated to achieve. And this may be the start of prices or inflation coming back down towards that 2% target. Yeah. So the data has to support the narrative. Yeah. You can't just start buying willy-nilly or selling willy-nilly. You know what I mean? You have to, there has to be legs to the rumor. There has to be supporting evidence, yeah, to the rumor. Yeah. So make sure that you keep your finger on the pulse. Trust bank forecasts, right? Trust the banks. I know people don't trust the banks, and there's times where you got to be kind of anti-establishment in certain respects, and I'm not one to necessarily trust the establishment. But when it comes to bank forecasts, I trust them. And the reason why is because I'm not saying that they're going to be right all the time or wrong, but just to kind of illustrate a point is that banks are not in the business of misleading their clientele. Yeah, they're not in the, they're paid, clientele, and the people that they're managing money for, right? They're not in the business of doing that. They need to have credibility. Yeah, so when they produce their bank forecasts, they don't know who's reading it, right? It could be a massive, investor, right, who subscribes to Bloomberg or the Financial Times, and they got an analyst, who's quoted as saying, we think that the euro dollar is going to go down, for example, right? It's going to continue to devalue. Yeah. Now, they could basically make decisions, their clientele or a potential client could make decisions based off of what they're saying, right? So they're not trying to be wrong, because if they're wrong more often than they're right, yeah, then they're going to lose all credibility and they're going to get money. So trust bank forecasts. Yeah, I'm not saying that the forecast today. Yeah, because again, as I'm going to remind you and repeatedly remind you, this is medium to long term trading. Yeah, this is medium to long term trading. In the short term for this week, who knows what price is going to do? Mark is going to show you basically how the market makers work in the short term and how to really kind of trade short term. Yeah, as well as medium to long term as well. But from the perspective of trying to predict where price is going to go in the short term, yeah, is really a bit of a fool's game if you don't understand the market makers model, right? I can tell you that now. And I've traded, I've probably bought a whole load of courses. I've probably spent I spent maybe 15, maybe 20 grand on indicators in the past, right, when I was learning. And I can tell you something. I can tell you now, right? God is my witness, right? It is just it's technical analysis. If you don't know, I guess order flow, market maker stuff, you're just going to be lost in the wilderness. Anyways, trust the banks. Combine fundamental divergence trade ideas with higher time frame zones. So we always look at it from a macro perspective, yeah, from the bigger picture. So the best zones, whatever technical strategy you're trading, yeah, look at it from the higher time frame perspective, whether you're trading supply and demand, whether you're trading support and resistance. Daily zones, daily levels are really where you want to have that perspective. Yeah. 5 minute levels, 1 minute zones, these 1 hour zones and levels are just not going to cut it. You really need to look at it from a bigger perspective. And that's not to say that you shouldn't trade the lower time frames, of course, but let's say what ultimately what you want to do and what we do at Trading 180 is understand basically, we're looking at daily zones first of all, right? That's a demand zone, for example. Prices might come up, so we do our fundamental analysis. We understand the price has been coming up, whatever it is. This is an area of value, and then from a daily perspective, and then we look to or a weekly perspective, and then we go down into the lower time frames and look for our trade entries and trade setups, whether it's stop hunting, catch pain relief, or just daily supply and demand zone setups. Yeah, so you can go into the lower time frames when you're looking for entries and micro levels, but overall what you want to do is have that daily and look for daily and weekly zones, whatever your technical strategy is currently. The market marches to the drum of its own beat, not yours. So what do I mean by that? I mean that the market works in its own time. Yeah, just because you're trying to pass a prop firm challenge, or because you need to make money, today, this week, or even this month, yeah, it doesn't, the market doesn't care. It doesn't care what you want to do and what your targets are. Yeah, generally. Yeah, the market. I don't want to get too much into it, but how the banks and financial institutions have to do the business model between institutions and market makers. Yeah, it takes time for them to fill their orders, right? So banks, institutions may take at least a week, a month, 2-3 months to fill their orders before prices may go higher, right? So again, I'm not really trying to get into technicals around it, but just understand that fundamentally we want to be buyers. That might be maybe a week or two of trading. Yeah. Now, many people will say, well, Leon said to buy the euro dollar or sell the euro dollar, and it's been going sideways for the past, week or two. That's not our concern. Eventually it will go higher or lower. But what has to happen in more of the short term is more of the auction phase. Yeah, the buying and selling, of euros. Liquidity has to be got. Yeah, iceberg orders, etc. has to be accumulated. And banks don't have the luxury of being able to fill their orders just in one click. Right? Like retail traders. We just buy here and then that's it. Brilliant. But they have to accumulate. They have to, be able to buy in, over a period of time. So fundamentals, and as I say, medium to long term, you've seen the euro dollar, right? You saw the euro dollar go down. You saw the dollar yen go up. Were there periods in that euro dollar downtrend where you might have had a week or two or even a month or two of prices rising? Of course you would have. Yeah, but overall, the path of least resistance was to the downside. In the same way that the yen was going sideways for maybe periods of time before going higher, maybe even went lower. But generally, the path of least resistance was to the upside. Yeah. So in the short term, it's really about understanding, value. And the market marching really to the beat of its own drum, not yours. You can't put a time frame on when these things are going to happen. But trust me, they will, right? They will. So other fundamental trade ideas do include convergence and risk sentiment. I'm not going to get into that in this one, maybe in another webinar, maybe not. It depends. But the guys definitely who are in the group will know about convergence and risk sentiment ideas. We just really kind of focused on divergence ideas. And also as well, finally, just quickly as well, don't get married to forex pairs. Really and truly, your forex pairs that you trade should be dictated to you by the fundamental analysis and looking for that trade idea, right? Looking for the divergences or the differentials in monetary policy, whether a central bank is hiking rates, another one is cutting rates, or whether you've got leading and lagging monetary policy. That's where you're looking to trade. Because that's where hopefully where prices should go, either to the upside or to the downside. If you're trading two currencies where the central banks are looking to hold rates, then who knows where prices may go? I don't know. You know what I mean? In the medium to long term, nobody knows, because it's a straight fight. It's like betting on a boxing match where you've got two evenly matched fighters. It's harder to make money on that bet than it would be to bet on a fighter who is in tip-top shape versus someone who hasn't been training and is maybe in his bloody 40s. You know what I mean? There's easy bets out there. It doesn't happen every day or even every single week. Yeah, it can. There's times where we get loads of trade ideas. Everything kind of aligns and we have so many trades we don't know which ones to take. And there are some days where, and maybe some weeks where, there are slim pickings. We can't, trade based off of what our time frame is. The market, is a relationship between the institutions and the market makers. Yeah, it's their business model. It's not ours. Yeah, so we have to pick and choose when we trade and when we don't. And as I said, there's some weeks where you might have 10 trades. There's some weeks where you might have one trade. Who knows? Yeah. So don't get married to forex pairs. If the fundamentals are not clear, right, on your favorite pair, I hate that saying. Oh, my favorite pair is that's nonsense, because your favorite pair is dictated to by fundamental analysis, right? And if it's not clear, don't trade it. There's nothing wrong with not trading, the GU. There's nothing wrong with not trading the EU. If it was once trending, yeah, or once the fundamentals were clear, yeah, and then all of a sudden now, say all of a sudden, but generally there becomes less of a divergence. It doesn't become as clear. Just don't trade it, right? Look for where there are divergences, and there are always divergences. There are always divergences, from risk sentiment divergences. I've obviously just shown you one, and there are convergences. It's always trade ideas that you can, but from a divergence perspective, this is where we are, right? So those are really my top tips, yeah. And that brings me really to the end of the webinar. And Mark's, just so told you about tomorrow. Just as a reminder, day 2, footprints of the market whales and how to trade alongside them. Tomorrow, Thursday, 17th of February, 8 p.m. London time. And I was going to say email Mark, but you've already got the links, so don't worry about that. And pretty much just a Q&A now. There is something I do want to go over just quickly as well. I forgot I put this in the slide, matter of fact, just quickly, because I do get this question a lot. And the question is should I always buy the currency with the highest interest rate? And the answer really is no. Because the highest interest rate doesn't always dictate, where you should be buying. So I'll give you an example, right? So let's say, for example, you've got a currency that has 5% in interest rate, right? And you have one that is at 1%. This central bank is looking to hold rates, yeah? But this central bank is looking to hike rates. Which one should you buy? Which one should you buy? Which bank should you buy? Bank A or Bank B? B. Oh, someone said A. Someone said A. A few people said A now. Oh, you should really be buying B, right? Anyone who said B is correct. Because what's known about the valuation of this currency? The central bank are not looking to do anything. They're not looking to appreciate or depreciate their currency, right? They're looking to hold rates. They're comfortable with where it is. Whereas this currency or this central bank are looking to hike rates from 1 to 1.5, maybe to 2 to 2.5. So these guys are actually appreciating their currency, whereas these guys are not. So by default, you will have the valuation. You will have, if this is obviously, this might be, the euro, for example, and that might be the dollar. Yeah. So if you're buying euro dollar, EU, yeah, and this is what happens, then you want to buy Europe. You want to buy the one with the lowest interest rate, because they're looking to hike rates and they're looking to appreciate their currency, whereas the one with the higher interest rate actually isn't. They're looking to hold rates. So there's a tip right there. There's a massive tip right there. A lot of traders get that wrong. In fact, I'd probably say, again, 99%. I haven't seen not one trader, not like I'm looking online or anything like that, but they don't tell you that. Yeah, they don't tell you that. I'll tell you that now. It's true. Anyways, and the second one before we get into the Q&A is, and I'll do the Q&A for maybe another, maybe about 15 minutes or so. Right, so can I apply fundamentals to the 5-minute chart? Yes, of course you can. But, and I think I probably alluded to this earlier, or actually I said it earlier, is understand where you are on a price chart. Apply the higher time frames. Yeah, you must look at the higher time frame levels, higher time frame zones, yeah, in order for you to trade in the 5 minutes. Because what you're ultimately doing, again, like I said, if you're coming down to maybe a daily or a weekly demand zone, then fine, brilliant. You can trade the 5 minute in there, right? Zoom down into that zone, but you have to look for higher time frame levels, because those are the ones that are going to be traded the most. So, all right, that brings me to the end of the webinar. I'll do a quick 15 minutes and I've got a few questions. I will start with Lloyd. Lloyd says, can you please show us how you prepare fundamental analysis spreadsheet? I will say that not in this webinar. Not in this webinar, but the fundamental analysis spreadsheet is really for the guys in the group, and I think I might be doing them a bit of a disservice if I do, you know what I mean? It's a bit of a trade secret, so unfortunately not. How do we combine inflation and interest rates to GDP when they are contradictory? How do we combine inflation and interest rates to GDP? Well, first of all, you that's not the way to look at it, because interest rates are dictated by GDP and inflation. Almost like you have to look at it like this. Yeah. As I said, all roads at the beginning. I don't know if you was there at the beginning, right, to answer that question, but all roads lead to interest rates. So that's the most important, right? And then below that, you've got inflation and GDP. GDP. Yeah. So this is like the king. This is like where all roads will lead. This is the final destination. What the central bank will do with currencies, either appreciate or depreciate or devalue, right? That's basically what we're talking about. So depending on what happens here and here, inflation and GDP will determine what central banks do with interest rates. And that's all I'm concerned with, right? If GDP is growing and inflation is above the 2% target and trending away from that 2% target as far as trending higher, then I know that the central bank is generally going to hike rates, so I want to be buying that currency. That's it. Yeah, that is it. I'm not trying to remix this and trying to look at what's going on with GDP, looking at inflation and interest rates. That doesn't make any sense. Why would I want to do that? So no worries, Chalky. Can you please open membership? No. Subby. I'll think about it. I'll think about it. Rewatch the video. Okay. What banks that do analysis which we can trust somehow? That's from no. So pretty much all the banks. All right. I'll give you. You know what you should. If you go to one of the banks and one of the free websites and that I use pretty much religiously is ING. Yeah, there are several. There was probably maybe around about 10, 11, 12 banks in the group that we look towards analysis wise. But I'll give you one of the free ones, and it's Think. THINK. .ing.com, right? Lots of info there. Great analysis, and you know, that will definitely help you out with the forecasts, what's going on in the economy. You know, you can. There's Bloomberg. You can. You know, I wouldn't say subscribe to that if it's not in your budget. You can if you want to. If they do like maybe a 3-month trial subscription for maybe like £10 or something like that, then definitely worth it. If you find it worth it. ING, yeah, the ING Bank, right? ING Bank. They're a Dutch bank. Great analysis. I'm just scrolling back through the questions. Okay, please where can we get GDP, inflation, interest rates? Right, so that would be trading economics. So trading, TRADING ECONOMICS. Right, to get all that data. Tradingeconomics.com is where I look towards for my data. Do you take into consideration the amount of loans with fixed and variable interest? Nah, don't do that. There's no reason to take into account loans and fixed. And as I said, I don't know if you was at the beginning, Oringo 1. Eliminate the noise, right? There's a lot of noise. There's a lot of distractions. Yeah, this presentation literally tells you what to focus on. Like, I wouldn't say there's nothing else. Yeah, there are some other things in here that you could, but you don't need them. This is what you need. Yeah, this is all you need. This is like keys to the kingdom, or this will definitely give you a great trading idea. There are, as I said, other trading ideas, of course there are, but this is one of them that will definitely set you straight. And if you can understand this, then you should be all right. Difference between GDP year on year and quarter on quarter. Year on year is measured obviously every year, quarter on quarter every quarter. You want to look at probably more focus on quarter, because that's where you will find out. It's a shorter time frame, first of all, and also two negative readings. Yeah, two negative readings of quarter, 2 quarters negative readings will equal a recession. Right? Recession. I think ESS. Recession. So it's better. It's you know, if you're gonna, I mean, you can focus on both, but the most important reading is the quarter on quarter. News. Yeah. So news that affects inflation and interest. So news that affects inflation and there's lots of news. What I would say is try to focus on things like wage growth. And again, you can go into so much. There's many different areas to focus on. Focus more on things like just CPI, right? CPI data, yeah, is one of them. Wage growth is definitely another that the central bank generally tends to focus on. There are obviously other, inflation data like, commodity prices, supply chain problems, but generally what you want to focus on is mainly CPI. Yeah, mainly CPI and wage growth. Just a practical question. You cannot attend tomorrow's webinar. Will it be recorded? Oh, that's up to Mark. That is up to Mark. Unfortunately, I don't know. We might just want to make it exclusive. Sorry, Ian. Let's see. Asabe, attend Mark's webinar and you'll see. Yeah, attend Mark's webinar and you'll see, Asabe. Flawless. With what we have learned from you today, can you look to sell the euro dollar in the near future? Absolutely. I'm a seller of the euro dollar. Yeah, and we've been sellers of the euro dollar pretty much most of the year, I would say. Actually, pretty much all year, probably from around about January, I think. It was mid-January, if I remember correctly. I've been a seller of the of the euro dollar. So yeah, I mean, the divergence isn't there anymore as much anymore, right? And the reason why is because the ECB, right? ECB, Christine Lagarde has come out and kind of given the markets a bit of a rumor that they may want to hike rates this year, even though the Fed are way ahead of them. I do think that towards maybe the second half of the year, we could get a decent pullback on that euro dollar. But my bias is still to the short side. It's still to the short side for sure. Right. I am still getting confused on how to identify economic cycle of a country. Please, just a little bit more. Well, just think about your own country. I think is it No? I think it's how you pronounce it. Think about your own country, right? Think about your own country. Where are you in terms of are you growing? Yeah, are you growing? Are you seeing the GDP data start to grow? If you are, yeah, then you're probably in either the recovery, the expansion phase. The boom phase would be when everything is lovely and everything is brilliant, right? But you're probably either in the recovery or the expansion phase of the economic cycle. That's what I would say. It depends on where you are. If obviously your GDP data is going down, then you're not, right? You're probably in the contraction, the recession or the bust slump, phase of things. Yeah. So from that perspective, that's really where you are. So and again, you just by generally having a look, reading, and looking at the data, you can pretty much see where you are or where a country is. Zayed, you keep asking that question. Sir, can you tell me news that affects interest rates and inflation and GDP? News that affects interest rates, inflation and GDP is news that says, about interest rates, inflation and GDP, right? So what affects, again, the economy. What makes up the economy? For me, I tend to, right? So you can, if you go on Forex Factory, you've got loads of different, points. Right? And this is why I say all roads lead to GDP, right? So let's say you got GDP here, right? Now below GDP, you're gonna have all these other data points, yeah. Whether it's home building, whether it's manufacturing, whether it's retail, sales, da 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 da. You've got everything, yeah. All of these little data points, they all lead to GDP. Yeah, they all lead to GDP. Now, while I have a slight eye on that, that's fine to have, to just be aware of what's going on. But I filter out generally this noise. Yeah, I'm aware of certain things, of course, and every single tick that happens, you might get, maybe a bit bad data there, you might get good data there, right? So you might have 4, 5, 10 different data points that are great. You might have maybe 2 that are bad. But ultimately, I'm looking at this number. I'm looking at, did GDP grow or did GDP stall or did GDP shrink? That's what I'm looking at. Yeah, so I'm not really focused on, and I'm not saying that you shouldn't be focused on it. Of course, definitely be aware of what's going on. But all of these generally will add up to this. And also as well, again, the shortcut was understanding what the central bank is doing with interest rates. The central bank are basically the smartest guys in the room. And if you read their statement and they're saying that they're continuing to hike rates and they want to hike rates, yeah, it pretty much means that they think that GDP is going to continue to grow, right? That's the shortcut, because they're looking at GDP. Anything that you think you're being clever with in a sense that you think you're looking at something that no one else is looking at, the central bankers are looking at everything. They're taking into account every single data point. And they're saying in their statements, they're giving you the shortcut. They're saying, we've looked at the economy and we're hiking rates still. That should tell you everything you need to know. Yeah. So there is a cheat sheet there. You know what I mean? Looking at the central bank statement, but also as well, just looking at general GDP and inflation and looking at that data and where it's going. Marianne, welcome, Marianne. How you doing? When should we start buying and selling? When the rumor appear or when the news is published? Well, they go hand in hand, don't they? Because you don't really get the rumor until you see, pay attention to certain news, right? And I guess the data. So it really depends on where you are in the cycle, right? So let's say, for example, Marianne, let's focus on the euro. The euro is a good example because the euro has been weak for so long, yeah, and it's been lagging behind lots of other central banks like the New Zealand dollar, the US dollar, the Canadian dollar, etc. Right? They're lagging behind. The rumor now has started to change, hasn't it? Right? The rumor is that they might start looking to hike rates. Yeah. So the rumor started with really the central bank. Yeah, because they've looked at inflation. Yeah. And they've said inflation is way above. It's like 5.1 or something like that right now. So it's way above their 2% target. Yeah, 5.1%. Now, they've come out themselves and said and given a signal that they might want to hike rates. So the rumor now has started directly from the ECB. So then what will give this rumor legs? What will give it more credibility? If inflation is above there, what do you need to see as a trader to believe that they are likely to hike rates? What needs to happen? Exactly, guys. Exactly, Marianne. GDP data, right? Because the ECB are not going to hike if GDP is still flatlining. They need to see some good figures. So if you so the rumors started now, right? So you could price might come down to a level, right? And you could say, all right, then there's a demand zone, for example, on the Euro Swiss, right? Which is a pair that I'm definitely interested in buying right now. Yeah, so prices have come down to a level, and the ECB have now turned around and said we need to see GDP data. Now, of course, I'm going to want to start to look to buy, right? I'm going to have to look to buy. I don't know what GDP data is going to be, but what I do know is that the smartest people in the room have started the rumor. Now, they've obviously looked at GDP data and said, well, it's probably maybe about time we should probably start to maybe, start the rumor. Now, they don't know and I don't know. Nobody knows. There's no certainties. But what I can do as the rumor starts, I can start to scale in. Yeah, I can start to add a small position. Yeah, so buy the rumor. Yeah, buy the rumor. So I start to add in a small position as soon as the rumor starts. And then as time goes on, and then you get good GDP data, yeah, brilliant. You can stay in that trade because then the rumor starts to have legs. Because the rumor, when you're buying the rumor, everyone else is going to start to buy the rumor, right? Everyone's starting to look to buy on pullbacks, etc. Market doesn't move in a straight line. But once the rumor starts, it's then up to you to decide, you know what, is this rumor likely to happen or not? Do I believe the rumor? And so if you start to believe the rumor, then why not just put on a small position, right? And then maybe once it starts to have legs, then you can start to maybe add a full position size on and start to trade it, with full positions. But it starts with a combination of things. So it starts from the ECB. It can start with the actual data itself, confirming that fact, or the data coming ahead of the ECB, because sometimes that happens as well, or central banks. The data can confirm what is happening in the economy, and then what you'll generally see is then central banks say, well, we looked at the data and we think that that's what it is, right? We're going to hike rates or cut rates, for example. So as long as the data is getting better, then it can be a combination of things, whether it's data or whether it's the actual ECB looking to but that's where the rumor starts. But you won't know where the rumor starts unless you understand GDP, interest rates, or inflation, and the relationship between those three. So I've got to scroll up because there's a load of questions. Right, I'm going to stay on for another. I'll do another 10 minutes. I'll do 2 hours. Right, so let me just scroll up a bit. So I did answer Marianne. I hope that answered your question, Marianne. But Marianne, you're in. Yeah, I'll speak to you in a bit later. Ambrose, how long are your trades open for on average? I'm not getting into that, Ambrose, because it really doesn't matter what I do insofar as I swing trade, right? I swing trade, and that's what it is. We're talking about the fundamentals right now. How do you get the marks? Well, if you're here, then you should have the same. You should have the link, Ambrose, to in that same email to Mark's webinar. So in that same email that I sent, or Mark sent, I think he would have put in the webinar. If he hasn't, then you probably will get a link maybe tomorrow. You'll get an email tomorrow. Alex says, yes, that would be the best thing to do right now. Press conference. Yeah, press conferences can also start the rumor. But any example, the US had inflation higher than the euro, and the US did not hike rates. I don't know, but they're going to hike rates, right? They're going to hike rates. That's what it is, Alex. They're looking to hike rates this year. So the ECB are not looking to hike rates anytime soon. So again, that leading and lagging, right? So in the and again, we're buying the rumor that they will. Yeah, this is the rumor. So the rumor has already started. The rumor started a long time ago, way before you got into this before you got into this webinar, right? Me and the guys in our Discord room, right? We're shorting the euro. That's all we've been doing, is shorting the euro over the past year. So we've been buying the rumor way before the rumor started. Yeah, because now once everyone starts to buy the dollar when they start to hike rates, that's maybe where you want to sell the fact. But I don't want to get into that because that brings us into something else. In the US and JPY slides, what if US GDP was down? would you still go long dollar? Yes, of course not, Lex. Why would I want to go long the dollar if the GDP is down? Right? You answered your own question. No need to. Why EU was in buy mode? I have no idea what that means. Sorry, Alex. Dan, Dan, you gotta watch your mouth, man.
All right. I'm so sorry.
Yeah, no worries. Did you wanna ask a question, Dan? No. All right then, cool.
Like, yeah, can you hear me?
Yeah, I can hear you.
All right. Like, I was so surprised, like, to see that the webinar is still on. But already, I have a question in mind.
All right. You know what? When did you join?
Yeah, like I was in for like up to like 30 minutes, and so like
Unfortunately, okay, Dan, I'm gonna say this, yeah. Unfortunately for you, I cannot go over the webinar again. I'm afraid you missed it. So yeah, there may be a recording. I was toying with the idea of a recording, but I do want to generally reward the people, who turned up, for the webinar, and I'll think about releasing the recording. I really will think about it. I'll don't know whether I will.
I'll be very grateful. I'll be very grateful.
Yeah, I might do. I may do. Yeah, because again, I don't want this stuff floating around online forever and a day. This is years of hard work, by the way. This is trial and error. You know what I mean? You know what I'm saying? It's funny. Everybody wants to share information. It's funny, yeah. Everyone wants to share, and I don't mind sharing information, of course. You know what I mean? It is what it is. It's not necessarily that, but in a sense of, there is
I've been dying all day, like to hear about this, because I know I really need it in my trading journey. Like, I know it's going to help me fundamentally. Like, I've been having issue like grabbing the concept fundamentally, bro.
There's a lot that goes into it, but trust me, this is really the basics. But thanks, Dan, and unfortunately you missed it, but I might release it a bit later. It depends. Let me get through the questions though quickly. 1 second. So Flawless says, please, do you think the Kiwi is a bargain now, fundamentally and technically to buy? Yes, I do. And again, I'm not giving you financial advice, please. I don't want to give you financial advice. I'm not saying anybody will go and buy now, but it is definitely a pair that I'm interested in. You have to be just careful of risk off. Yeah, risk off sentiment, because risk off sentiment is something that goes against commodity currencies and can strengthen safe haven currencies like the yen and the Swiss franc. Yeah, so just be careful of that. But I do think risk off sentiment is dissipating, and I think we're probably coming. We're in a bit more risk on mode. So I am looking for buy trades on that New Zealand dollar. Do you see euro going below? No, I don't. I don't see the euro dollar going below one. Does fundamentals work for indices? Well, I only trade forex, and I know it works for forex. I have no idea what works for indices, unfortunately. GDP is lagging indicator. Again, I think when people say lagging indicator, like it's a bad thing. Of course, it lags simply because they have to collect the data, right? There's you think about the amount of information that you have to collect, yeah. But it being a lagging indicator doesn't stop and never stopped us from making money, right? It's all about understanding what is likely to happen is happening now, and what is likely to happen in the future, right? And yes, GDP might be technically a lagging data, I wouldn't say indicator, but it's a lagging data, but it's the most important. Yeah, it's one of the most important things that you have to look at, right? So do you use other indicators leading to predict if GDP shall be positive or negative? I would say look at jobs. Jobs is generally a good indication. Jobs, employment, unemployment is a good indicator of whether the economy is doing well. So does retail? No, it says does retail sales influence and affect? I have no idea. Favor, no idea whether retail sales data influence or affect CPI data. Japan economy depends so much on export. How this relate to the value of its currency? So exports generally help an economy. And let me just delete this, I guess. Exports help an economy because the more you sell, which is exports, rather than imports, should boost economic growth, right? So just think of your own pocket, if you're spending more than your I'll think of a business, I should say. So if you're spending more in your business, for example, wages, rent for the building, etc., equipment, then you are getting customers in, then you're going to be in what's known as a deficit, right? You're going to be in trouble, But if you're selling more than your overheads, then you're going to be making money. It's the same thing with imports and exports. So as long as exports, are more than imports, it's what's known as, I guess, Lord, my brain's gone blank. I think I'm just tired. It's called you've got surplus. That's surplus. It. Yes, trade surplus. Thank you. Thank you, whoever that was. Thank you. Like I said, I've been talking for 2 hours and my mind just went blank. Trade deficits and trade surplus, right? Trade deficits, trade surplus. So if you've got a trade surplus, I mean, most countries, apart from maybe Australia, I think it is, and New Zealand, generally have trade deficits. And I think maybe Canada might have a trade surplus, but I'm not too sure. Basically, exports help you to get to a trade surplus. And if your trade deficit keeps going down, meaning that you're importing more than you're exporting, it will have the effect on your GDP, right? It will have an effect on GDP because you have to really kind of sell more than you're buying. And that's the reason why China export more than they import, right? I don't think, when was the last time China went into a recession? I have no idea, but because their currency is so cheap and it's managed by the People's Bank of China, they can afford everybody, the world, pretty much, the UK, the US, wherever you live in the world, generally will go to China to manufacture goods, right? Because you can manufacture goods for cheap. And then China will export those goods to the world, right? So they sell way more than they import, because I don't know if China buy UK goods. I don't know if China buy, as much US goods or European goods. Of course they do, but the balance is definitely not from the perspective of, they sell more to the world than they probably buy, right? It's just, and that's why their economy is generally always tip top. So the question being is from a Japan economy depends much on exports. I think most economies do. It would relate to the value of its currency. And if we go back a few slides, or if you remember the Japan economy, was in the negative for ages. I think it was negative for a while, and then it's only now just returned to some sort of growth, I think, and then it went down. Oh, that was inflation. Sorry, it wasn't negative for ages. I think it was like that last year, 2021. I think it was 2022. Obviously, we all suffered, with the recession due to COVID, but I think the recovery was very uneven. I think it was down. I think it was minus. Then it went into positive. Then it went into minus again. So they're struggling with, obviously, the COVID. They were struggling with the recovery after COVID, whereas other countries like the UK, for example, and the US, they managed to get COVID under control, which then means that they, were first out of the blocks when it came to GDP, right? Because they didn't have as many lockdowns, etc. Same thing with like New Zealand, etc. So, but imports, going back to exports and that, it does help the economy directly, which then would affect the currency. I'm gonna maybe answer one more question because it is 10 o'clock and I did say I'd have 10 minutes. So unfortunately, fortunate for Thomas, but for everybody else, unfortunately, I'm not going to be able to answer any of your questions, but Thomas is the last one. So how long have you been trading this way? What's the average length of your... Okay, I'll answer the how long I've been trading this way. And I've been trading this way for 4 or 5 years, probably, something like that. And again, I'm not really going to get into average length of my trades because everybody's different, right? Everybody in the group is different. And that gets into really how I, trade, and it's not really about that, unfortunately, Thomas. I don't really want to go into it in this webinar. But generally, I do swing trade, right? I do both. So not to say I day trade and swing trade, but I take short-term profits, but I always leave positions open for the swing trade for generally the medium to long term. And when I say always, it also depends because fundamentals can and do dictate how long I hold trades for. Because if something changes, then I'm going to take profit, right? If something changes in the fundamentals, then I will take profit. It's not the only reason why I take profit, but generally I'll have an idea as to the next maybe 1 to 3 months what is potentially happening, and I will get into and out of trades and swing trade. The longest I held a trade for was gold, and I held it for silver, and I held it for about a year. Biggest trade I ever made, and that was something like an 85 to 1 trade, and in fact it was probably maybe a bit more because I was kind of getting in and out, but one of my positions ended up being like an 85 to 1. So yeah, that was, and that's all documented, by the way, just in case you don't believe me. I did that in the group, and there's evidence of that. So, unfortunately, guys, all the questions are, I can't answer any more. So I'm going to end the webinar now. I hope you found it useful, and don't forget, please. Mark Chapman is going to blow your mind tomorrow. Seriously, man. That guy is, he's very, very plugged in to what's going on. It's not nonsense he's talking about. What he's going to show you literally, and what he showed me, is literally, from a market maker's mouth. Yeah. From an actual market maker, not theory. Yeah. It's not, anything like, okay, well, Wyckoff and all this nonsense that I wouldn't say it's nonsense, and it's not nonsense, but anything you see online on YouTube right now, these concepts are actual market maker business models. So I implore you, please just turn up, and listen and really get that knowledge, and what he's about to say. Anyways, guys, brilliant. You're welcome, guys. Have a great evening wherever you are in the world. Stay safe, and speak to you all soon.